If you have ever thought, I don't know where to invest or I don't have the time to figure out investing, then this video is for you. Because in it, I'm going to share with you 5 ideas for a one mutual fund portfolio that can take care of all your long-term investment needs. And here's the best part. Even though it's a one mutual fund portfolio, that doesn't mean that you have to sacrifice on getting great returns. In fact, let me share the example of one of the ideas that I'll be talking about. If you had started a 10,000 per month SIP in it with a 10% annual step up, that would have grown to 6.6 crores over 25 years. Whereas in the Nifty 50 index, that would have grown to about 4.5 crores. That's over 2 crores extra. And while doing that, you don't even have to take on any additional risk, even though it's a one mutual fund portfolio. This strategy is designed to help you grow your wealth while simplifying your investments. So even if you have zero time and zero financial knowledge, you can still build massive wealth. Wouldn't you prefer having that extra money without needing to constantly research stocks or stress over your investments? A one fund portfolio gives you back your most valuable asset, which is your time. That means less stress, more freedom, and the ability to focus on what really matters, whether that's spending time with your family, learning something new, or pursuing a passion. Because at the end of the day, if you think about it, money is a tool to help you live the life that you want. So by simplifying your investments, you're not just growing wealth, but you're gaining the freedom to live the life that you truly desire. Hello everyone, I'm Uday Nadhe. I've been licensed in Indian financial services since 2015, first in insurance and then in mutual funds. And so far, I have helped over 1,500 families take better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. The first type of fund for a one mutual fund portfolio is an aggressive hybrid mutual fund. And before we dive into it, if you want to learn more about investing, I'm hosting an exclusive personal finance masterclass on 15 September Sunday. In it, you'll get access to 8 proprietary finance calculators that I actually use while working with my clients, and you may have seen a lot of these Excel sheets in the videos on my page. You will also learn how to select mutual funds for your long-term goals like retirement, or also how to select investment options for short-term goals like, let's say you want to go for a vacation. And for every masterclass registration, I'll be donating one meal to 3 underprivileged school-going kids in India. Spots are limited, so grab your seats soon through the link in the description or the QR code that you see on the screen. Now let's talk about the first type of fund for a one mutual fund portfolio, which, as I shared, is an aggressive hybrid fund. Now, this type of mutual fund invests both in stocks and bonds. As per SEBI rules, an aggressive hybrid mutual fund has to invest between 65 and 80% of its money in stocks and 20 to 35% in bonds. Now, this mix of stocks and bonds makes aggressive hybrid funds super interesting. You may think that having bonds in the portfolio would reduce its return, which is perfectly rational. But what if I told you that is one big misconception? Let me put that in perspective. A 10,000 per month SIP with a 10% annual step up in the aggressive hybrid category would have become 4.64 crores in 25 years, while in the Nifty 50, it would have grown to about 4.5 crores. And the aggressive hybrid category has taken on marginally lower risk while generating these higher returns. This is captured in the standard deviation, which is 2.06 for aggressive hybrid mutual funds, whereas for the Nifty 50, it is 2.17. This is also the safest investment amongst the 5 ones that I'll be sharing with you today. Now, one of the reasons for the higher returns in the aggressive hybrid category is because of the bond exposure. Ironically, people think bonds lower returns, but because these kinds of funds have 20-25% bonds, whenever the stock market tends to not do well, the bond element in this portfolio tends to pull up the portfolio because the fall is lower. So when the markets again start recovering, it starts recovering from a slightly higher price point. And because aggressive hybrid funds tend to carry lower risk than an out and out equity portfolio, they could be a wonderful idea for someone who's afraid to start investing in the market or a new investor. Let me show you the portfolio of a few big aggressive hybrid funds that have been around in the Indian stock market for a long time. So if we sort them as per the money that they are managing, the biggest fund in India is the SBI Equity Hybrid Fund. And if we look at where it is investing, you will realize how the split is between stocks and equities. So if you notice, equity is 72.32% right now, whereas the remaining is in safer assets that are non-stock market related. Now remember, in mutual funds, fund managers can change how much money is in stocks or bonds. So let's see what the allocation was like in December 2023. So back then, equity was 76.69%, which was very high. In March, it was 75%. In June, a little under 75, and it is the lowest that it has been since December right now, which is at 72%. Now, in terms of where this money gets invested, if you look at the stock holdings, Reliance Industries has the highest allocation amongst the equity part of the portfolio, followed by ICICI Bank and State Bank of India. And if you look at the bonds in the portfolio, you have got government bonds that are dominating the debt portfolio. So you have got a 7.18% Government of India bond that matures in 2033, a 7.3% bond that matures in 2053. These are the two highest weightage bonds in the portfolio. Now let's filter aggressive hybrid funds as per the average 3-year rolling return. So if you strictly look at returns, then ICICI Prudential, Quant and UTI have the best performing aggressive hybrid funds in this space. And if you go by size, then you have SBI, ICICI Prudential and HDFC that dominate this category. The second type of fund for a one mutual fund portfolio is a flexi cap mutual fund. Now these funds give fund managers total freedom to invest across large cap, mid cap and small cap stocks. Just a quick refresher, large cap stocks, according to the SEBI, which is India stock market regulator, are the top 100 stocks in India by size. Mid cap stocks are stocks ranked between 101 and 250 in terms of size, and stocks between 251 and 500 in terms of size are small cap stocks. Now in the flexi cap fund, there are no hard rules on how much needs to be invested in each of these categories. So the fund manager can shift gears based on where the best opportunities are at any given time. And that is the beauty of flexi cap mutual funds. They are flexible. If large cap stocks are doing well, the fund manager can focus on them. But if mid caps or small caps have opportunities and are showing potential for higher growth, the fund manager can easily invest more money there and tap into that opportunity. To give you an idea about returns, a 10,000 per month SIP with a 10% annual step up in the flexi cap category for 25 years would have grown to 5.75 crores. That's an XIRR of 14.1%. The same investment made in the Nifty 50 would have grown to about 4.5 crores. So the difference in returns is massive, and it is possible because flexi cap mutual funds also tend to have mid and small cap stocks, whereas the Nifty 50 only has the largest companies in India. And here's the best part. The flexi cap category traditionally has not taken on significantly more risk than the Nifty 50 and has a standard deviation of 2.32. Let's take a look at some of the biggest flexi cap mutual funds in India. The most popular one is the Parag Parikh Flexi Cap Fund, and it manages 75,000 plus crores. It's a fund that a lot of people know about, and we can see that reflecting in its AUM. We'll quickly go to its portfolio and see where it is investing. So in the past 5 years, it has generated for a lump sum investment a CAGR of 27.25%, which is again fabulous. In the past year, it has gained 37% plus. So if you had invested 1 lakh, that would have grown to over 1.37 lakhs. Here's where it is investing money. Its top holding is HDFC Bank, where 8% of its money is invested. And then it again has all these big names, right? Power Grid Corporation, ITC, Bajaj Holdings, Coal India, Maruti Suzuki. And what's interesting about the Parag Parikh Flexi Cap is that you'll notice that it has some international stocks in it too. You'll see here Alphabet, which is formerly Google, Microsoft, Facebook, and it has a few other international stocks as well. So it is one of these funds in India where majority of the money that it is investing is in Indian stocks, but it has a small allocation also to international stocks for international diversification. So you'd see right away that even though this is a one fund portfolio, it has over 50 stocks in it, and you're getting exposure to different sized Indian companies. And not just that, but you're also getting international funds exposure. So it's well diversified, and that makes, again, because it's a one fund portfolio, the risk of investing in it significantly less. Then you have the HDFC Flexi Cap and Kotak Flexi Cap as the second and third largest funds in India in this space. If we sort these funds as per rolling returns, then you will see Quant's Flexi Cap Fund has done the best with 34.33% returns. And then you have JM Flexi Cap and HDFC Flexi Cap at numbers 2 and 3 if you rank these funds as per 3-year average rolling return performance. The third type of fund for a one mutual fund portfolio is a multi-cap mutual fund. Now, these are a bit different from flexi cap funds because they have to invest in all three categories: large cap, mid cap and small cap stocks. So while the fund managers of flexi cap mutual funds can move money around freely between different types of stocks, a multi-cap fund follows a set structure. And as per SEBI rules, a multi-cap mutual fund must invest at least 25% each in large caps, mid caps and small cap stocks. That means you're spreading money across different types of stocks, which helps both balance risk and reward. Here's why it could be a wonderful idea. The large cap allocation can give you steady growth, whereas the mid and small caps can give you that extra injection of growth that large caps may not be able to give. A 10,000 per month SIP with a 10% annual step up in the multi-cap category over 25 years would have grown to a whopping 6.5 crores, which is an XIRR of 15%. And that's once again much higher than Nifty 50's 4.5 crores for a similar kind of investment. And this is understandable because multi-caps by nature have an inbuilt balance of large cap, mid cap and small cap stocks, whereas the Nifty 50 only invests in India's 50 largest stocks. And because multi-cap funds have a higher allocation to mid and small cap stocks, they have a standard deviation of 2.79, which indicates more volatility than Nifty 50, although it's marginally high. Let's quickly check out the top multi-cap funds. The filter that I've put here is that they should at least have been around for 5 years. So you'd see there are 7 funds that fit that criteria, and the biggest one is Nippon India Multi-Cap with 38,000 crores. Let's look at where it is investing its money so that we get a better idea. In the past 5 years, annualized returns of 28.71%, which is fantastic once again. The markets have been doing well ever since the COVID crash. So you'll see all these fund returns being very, very impressive. In the past year, this fund has done over 40%. And if you go to its portfolio, you will see a different kinds of stocks in it. So HDFC, ICICI Bank, Infosys, Reliance, these are the likely suspects because they're popular companies. And then you have 2 smaller companies here as well that you may not have heard of. But again, that is the beauty of multi-caps. You get a bit of everything that is offered in the Indian stock market. If we sort funds as per 3-year average rolling returns, then again, Nippon India is the best performer, followed by Quant and Mahindra Manulife's multi-cap fund. The 4th type of fund for a one mutual fund portfolio is a Nifty Large Mid-Cap 250 Index Fund. And this one is actually my favorite from this entire list. Here's how it works. 50% of the money in this particular index is allocated to the top 100 large cap stocks in India and the remaining 50% to the 150 mid cap stocks in the Indian stock market. So you're essentially investing in India's top 250 companies with just one fund, and this index is rebalanced once every 3 months. I love this index because of the mix of large caps and mid caps. Large cap stocks, which are usually more stable and established, help weather market volatility, whereas mid caps is where a lot of the growth could happen. So you get best of both the worlds, a diversified portfolio with the stability of large caps. And in fact, I had invested some money in this index for my niece soon after she was born 2 years ago. To give you an idea as to how this index has performed, again, a 10,000 per month SIP in it with a 10% annual step up over 25 years would have grown to 6.68 crores. That's an XIRR of 15.1%. And you see how it compares to the Nifty 50, where your SIP would have grown to 4.5 crores. And because this index has 50% of its money in mid caps, its standard deviation, that is volatility, is also marginally higher than Nifty 50's at 2.58. Again, it's not very high, but you should remember that when the markets are moving up and down, that even this index will move a little more than a pure Nifty 50 index. And right now, there are only 3 funds that track this index, and they're offered by Edelweiss, Zerodha and ICICI Prudential. Edelweiss in this space has the lowest expense ratio of 0.14, so that could be a good idea to consider. And in fact, that is where I had invested money for my niece. But remember, this is not a recommendation. I'm only sharing this for educational purposes. The 5th type of one mutual fund portfolio is a good old Nifty 50 index fund. Now, this is one of the most well-known and widely used indices in India, and for good reason. Because the Nifty 50 tracks India's top 50 companies. Remember, these are the biggest and most established companies across various sectors in the Indian stock market. So in a way, when you're investing in the Nifty 50 index, you're essentially owning a piece of India. Think of it as the foundation of the Indian stock market. And while its returns might not be as explosive as mid caps or small caps, you're getting a solid comparatively low risk investment strategy while investing in the stock market that grows steadily over time. And just because I said steady returns does not mean low returns, because a 10,000 per month SIP with a 10% annual step up over 25 years would have grown to 4.5 crores. That's an XIRR of 12.4%. Funds from Navi, UTI and HDFC can be considered if you want to invest in the Nifty 50 index. And in my masterclass on 15th of September, I'll be sharing an index fund selection tool and 7 other finance calculators that will make your investing life easier. The seats are limited, so register soon for it through the link in my bio. Now, if you're only investing in one mutual fund, there are a few important points that you should remember. First up, all these ideas that I've shared in this particular video have equity heavy portfolios. Even the aggressive hybrid fund invests about 65 to 80% of its money in the stock market. So while investing in any of these funds, you should at least have a time horizon of 7 years if it's a one-time lump sum investment. Whereas if it's an SIP, you should at least have a time horizon of 5 to 6 years. Because for lower time horizons, an equity heavy portfolio could be risky. The second important point to know is that all the ideas that I have shared are broad-based investing ideas. That means investing in a thematic fund or a sectoral fund, or only in a small cap fund or only in a mid cap fund may not be the best idea if you only want a one mutual fund portfolio, because once again, with just such a narrow allocation, you are increasing the risk while investing and you may actually lose money while you adopt that strategy. And lastly, why am I a fan of a one mutual fund portfolio? The answer is simplicity. So apart from saving time and effort, one fund portfolio can stop analysis paralysis and can get you to start investing. Because if you think about it, when we want to invest, there is so much research that goes into where we should invest, and that is great. But after a point, it's important to start taking action and then learn from that action. And having a one fund portfolio pushes you to take action because it is so simple. That's it for today. Tell me in the comments which other topics you'd like me to cover in future videos. Again, a lot of effort goes into making these videos, so subscribe to the channel and don't forget to register for the masterclass, and I'm excited to see you there.